Greetings and Happy New Year. Jeff First with Mike Sarchek. Welcome to this really short 5-minute video. We're going to be covering a few things, especially regarding your Matson money statements that you'll be getting in the next couple of weeks, as well as an outlook for 2015. So let's get started. The Dow, S&P, and NASDAQ hit over 50 combined record highs this past year. There has been high volatility, but the bull market has sustained. So let's look at 2014 returns. Starting with international markets, MSCI FA Index, and that stands for the Morgan Stanley Continental Index and European and Far Eastern Index, was a negative 4.48%. The MSCI FA Value was a negative 4.92%. The MSCI FA Small Cap Index was a negative 4.63%, and the MSCI FA Small Cap Value was a negative 4.86%. However, you can see why, looking at these returns, why we hold different asset classes and don't try to attempt to time the market. With emerging markets, MSCI Emerging Market Index was down 1.82% this year. The MSCI Emerging Markets Small Cap Index was up 1.34%, and MSCI Emerging Market Value Index was down 3.60%. Once again, you can see why we hold these asset classes long term. And when you compare returns over the 15-year period of annualized rates of return, 7.38%, 8.42%, and 8.5% respectively. Coming back home to the U.S. markets, the best performing asset category this year by far was the S&P 500, which returned 13.69%. The Russell 1000 Value Index was up 13.45%. The Russell 2000 Index increased 4.89%, and the Russell 2000 Value Index returned 4.22%. We think this is a great example that shows that even though the S&P 500 performed well last year, every media talking head won't let you forget about it. However, over the long term, the S&P has shown poor annualized returns compared to the broad U.S. market, with just 4.24% annualized return compared to 6.62% for the Russell 1000 Value, 7.38% in the Russell 2000, and 10.23% in the Russell 2000 Value Index. You might be asking, why aren't we fully invested in the S&P 500 market? Well, the truth of the matter is that the S&P 500 market over the last 20 years only had 3 good performing years. And on the flip side of that, over 20 years, had the 5 worst rates of return. So this is why we don't put all of your money in the S&P 500 market. When put into perspective, from this chart of all asset classes we invest in over the last 20 years, you can see the best returns in green and the worst returns in red. As you can see, there isn't a correlation between which category performed the best and which one will perform best next year. Another common concern is, why isn't my portfolio up 14–15%? Well, the reason for that is we're looking at a globally diversified portfolio. You have over 19 asset classes, 12,000 unique stocks, unique diversifiers. That's designed to give you global diversification. So we don't want your portfolio looking like the S&P 500. We want it to look like the global marketplace to capture global market rates of return. As you may have seen in the chart, none of the asset categories achieve the same rate of return as another category in any given year. It's because all of the markets don't move in the same direction at the same time. So we hope you can see why we diversify globally, why we don't invest based on what happened last year, why we don't market time, why we don't stock pick, and why we stay invested for the long term. Trust us, if we knew what the best asset category would be to put your money into, we would do it. And if somebody tells you where they know where to put it, then they're lying to you. So, with that said, Mike, how's it looking?
Well, that leads us into 2015. The question is what's going to happen next year, and a lot of people have asked that question. To be honest with you, we're probably going to expect another volatile year. But the volatility is actually good, and we want to remember that without volatility, there's no returns. So it's going to help when it comes to returns. there's the possibility of also the federal government raising interest rates. That might be creeping up on us this year as well. If this does happen, it's probably going to cause a whole bunch of commotion and ruckus and some additional volatility in the market due to the media hyping it up. As a seasoned and evidence-based investor, you know that staying the course is always your best option. So we don't want to make any drastic moves at this point in time, or ever for that reason. We're going to ride out all short-term volatility for the long term. It's not about timing the market, as it has everything to do with your time in the market. So what does this really mean for your portfolio? Well, really at this point, not a whole lot. As always, we're going to continue to buy and hold equities. We're going to remain globally diversified, and we're going to buy low and sell high, utilizing the rebalancing features of your portfolio. So if we take a look at this, and considering the last 6 years have been pretty good. Globally, they've been really good. We've gotten some great returns. Okay, so a correction, we're probably due. So it could be this year, it could be next year, it could be the year after. We're not sure, but we're always going to be following these simple rules to keep you on track. So with that, we want you to be prepared. And we know you've gotten our last invite, but we've got our next session coming up for the Investor Education Series, gearing up for the next crash. Don't let that scare you. We got a great opportunity for you to come and learn with us and be prepared for anything that might come down the pike here for this upcoming year. We want you to be prepared and stick to your financial goals over the long term. So please join us for this upcoming session. It's at our normal facility, Villa Penna's, which all of you know the food is always fantastic. It's a great venue. It's on February 10th from 5:30 to 8. Registration will be at 5:30. We start at 6. Usually end up about 8 o'clock. You can register by either calling Cindy at our main line, 586-463-1880, or visit us online at www.yourfinancialcoach.com and click the registration tab and register you, and feel free to bring guests as well, because it's going to be a great session. So we hope to see you there, and we thank you for watching.
Thanks.
Stay warm.